Okay, so we are going to continue our discussion with a financial assets. Okay, so from the beginning we learned that whenever a financial instrument is being issued, the presentation depends on who is the issuer and who is the buyer. Who is the buyer? Sorry. So if you are issuing a financial instrument or you are issuing debentures or bonds, you the one issuing, you are going to be recognizing this transaction as a financial liability because people's money are with you. You have an obligation towards the people who are buying the instruments. But those who are buying the instruments are having investment in your company. So they are going to be claiming ownership over that particular investment. Therefore, they will be classifying the financial instruments as a financial asset. So the financial asset, we are going to do the entry in the books of what? The buyer. So a company issued an instrument or equity instrument, and one company is buying. So the financial liability is done in the books of the issuer. But the financial asset, we are going to do the entries for the buyer. So if a company issue shares and you have purchased it, that is an asset for you. If a company issue debentures, bonds, and you have purchased it, that is an asset for you. That will be a financial asset. So for the financial assets, what will happen is that we first have to look at how a company may acquire a financial asset. So the acquisition of the financial asset can be through equity instruments, can be through equity instruments, and can also be through debt instruments. So financial assets can be acquired through equity instruments and also debt instruments. If I say equity instrument, what does it mean? You can acquire financial asset by purchasing the equity shares of a company. Or a company can issue equity shares and you decide to what? Purchase it and classify the investment as a financial asset. Okay, a company can issue debt instrument, bonds, debentures, and one company can purchase it and classify it as a financial asset. So financial asset can be gotten through two instruments, either equity instruments or debt instruments. So the form that the financial assets is being purchased through determine the classification. So if you come to equity instruments, if you come to equity instruments, the classification is only two. So if you come to equity instrument, the classification is only two. It's either through profit or loss or through other comprehensive income. So if it is equity instruments, you can classify the instruments or profit or loss, which is B for speculative purposes or trading purposes. You are just having the instrument there at the end of the year, you just sell it. You're just having it for investment for trading purposes. So you have purchased it for trading purposes or for speculative what purposes. You are not going to hold it up towards the end of the year. Within the year, you dispose it off. So that will be for profit or loss. So it will be classified to profit or loss. If it is classified to profit or loss, the meaning is that you can incur a transaction cost. But since the instrument will be sold within a year, it means that the transaction cost will also be consumed within a year. So what will happen is that the instrument is measured at the fair value, which is the nominal value. So the instrument is carried at the fair value, which is the nominal value. Any transaction cost is expensed. With the sense that the transaction cost will be consumed within a year. So the instrument will be sold within the year. The transaction cost cannot be spread over what? Certain number of years. It will be for only a year. So you just spread it over a year. But the question is, if you purchase the instrument 6 months to the end of the year, the meaning is that the transaction cost will only be what? 6 months, you charge only 6 months to the year. It means that the transaction cost is for a year. So you have done only 6 months, just charge 6 months. The remaining 6 months will be charged in the following year. That is if the instrument will be there at the end of the year. But if within the 6 months the instrument was sold, it means that the transaction cost must also be expensed out in total. The full amount must be spent out. But if the instrument will still be there at the end of the year, it means that the transaction cost relating to that particular 6 month must also be there. But whatever be the case, the transaction cost must be expensed because the assumption is that the transaction cost will be consumed within a year because the instrument will also be for a year. All right, let's come to other components of equity. Other component of equity, the instrument will not be sold within a year. So what we do is that we amortize the transaction cost. So instrument is going to be measured at fair value, which is the nominal value, plus the transaction cost. This is an asset. So if you are capitalizing a transaction cost, it means that it will be an expense that will be debited. And the asset is already having a debit balance. So we add the transaction cost. Okay, what will happen over here? For the equity instrument, what will happen? Someone can say it will be carried at amortized cost. That makes sense. But for equity instrument, there is no fixed amount of interest. There's no fixed amount of interest. So what you do is that you do the fair value plus the transaction cost. At the end of every year, the assets must be fair valued. So you look for fair value at the end of the year, which you find the fair value of the assets. So fair value adjustment at the end of the year, which can lead to a gain or a loss. Okay, someone can say it's through amortized cost, but there can be a year that they will not pay dividends. They will not pay dividends, and there won't be any fixed interest rate for calculating the dividends. So if the value of the item is 50 million, transaction cost is 2 million, it means that the distance will be carried at 52 million. Okay, if dividend was paid, what will happen is that the dividend will be treated as a finance income. So we have the fair value. So we count the finance income, which will be the dividends. So finance income, assuming it is 4. So that will increase this one 4. Okay, but the dividend will still be, so you can make it coupon. So the dividend can be coupon or something. Is the amount that you are receiving. So you receive the dividends in cash, it means that this will still be 4. So you see that the distance is still carried at 52 million. So because the income is 4, you will still receive the income in cash. So it means that if you add the 52 plus the 4, you will still reduce it by 4. Okay. So this will still be 52. So the calculation of the dividend is not important. But whenever you receive dividends, it should be charged to profit or loss as a finance income. So the instrument will be carried at 52 plus 2 million, with the sense that if the dividend is paid, if you add the dividends, you will still supply the dividend because you are going to receive in cash. Okay, so the instrument will be carried at 52 million. At the end of the year, you look for the fair value of this instrument. Assuming that the fair value is 55 million, it means that there will be a fair value gain of 3 million. And this will charge to other comprehensive income because the instrument is classified through other comprehensive income. So you send it to other comprehensive income. If there is a loss, the loss will go to other comprehensive income. That is about the financial asset through equity instruments. What about financial asset through debt instruments? So the debt instruments, we are buying debt instruments. Okay, so if it is through debt instrument, the classification is 3. We add additional one to this one. So the first one is true profit or loss, which is not different from this one, fair value. The transaction cost will be expense. Then for the profit or loss, at the end of every year, you also find the fair value of the assets. At the end of every year, you find the fair value. Any gain or loss will be charged to profit or loss. Okay, I've forgotten to talk about that one. So the instrument will be carried at the normal fair value, which is the face value, or which is the purchase amount. Then you take your transaction cost, your discount to profit or loss. Then at the end of the year, you look for the fair value of the assets. If there's any increase, the increase will be charged to as a gain to profit or loss. If there is a loss, it will be charged to profit or loss because the instrument is classified through profit or loss. All right, let's come here. The issue about the profit or loss over here is the same as this one: transaction cost expense, discount expense, fair value adjustment at the end of the year, gain or loss to profit or loss. This is the one. If we come here, we have other comprehensive income. So the other comprehensive income, the instrument is measured at the fair value plus the transaction cost. Then what we do is that this will be carried, subsequent measurement will be carried at amortized cost. Because the debt instruments, there will be a fixed interest rate for the debt instruments. So we can carry it through amortized cost. So at the end of the year, you look for a gain or loss on the fair value. So what will happen is that although you are carrying it through amortized cost, by the end of the year, you look for the fair value of the assets and compare with the amount that you have. So let's look at the example here. The example will be, let's assume that the figure was 50 million, the transaction plus the transaction cost of 2 million. So we have 52 million as the fair value. Okay. So let's assume that the effective interest rate was 5%, or the effective interest rate was 8%. So we have a finance income. Okay, 8% on 52 million. What will be that value? 8% on 52 million, 0.8 times 52. Okay,
4.16.
so I'm getting 4.16. So there will be a coupon payment because this is a debt. So let's assume that the coupon payment is 2 million. So it means that this will reduce this one by 2 million. So we are going to be having 54.16 million. Okay, that will be 54.16 million. This is supposed to be the normal financial assets, but this is carried through other comprehensive income. So what you do is that at the end of the reporting period, what is the fair value of this asset? So assuming the fair value is 56.16, it means that the value has increased by 2. So you recognize a gain of 2 million in the okay. You recognize a gain of 2 million in other comprehensive income. But the question is, if you want to calculate the interest for the subsequent year, on which amount are you going to calculate the interest? Would it be the 56.16 or it will be on 54.16? You can see that the 2 million over here is not part of what the agreement that we have with the people. The people will be paying the interest on the amount that they are owing us. So interest will always be charged on the normal value, which is the balance at the beginning plus the finance income minus the coupon. So you just charge the interest on this one. So in the following year, you will start with your fair value of 54.16, although it is now 56, but the 2 million over here will not attract any interest. You are just creating a reserve for what? For the fluctuation in the fair value of the instrument. So you charge your interest on 52.6, you have your finance income of 8% on that, then you have your coupon of 2 million. At the end of the year, the value that you are going to get over here, you add the 2 million to it so that you already have 56.6, but you're using 54. So it means that at the end of the year, the value that you get, you add your previous gain to it. Then you now fair value the instrument again. That is about that one. Okay, let's come to the second classification. Okay, the second classification is true. The third one is true amortized cost. But sometimes this classification will confuse you. So what will you see, or what will the question say before you know that this is true profit or loss? The question will say that this is for speculative purposes, or the question can specifically state that the person is classifying the instrument through profit or loss, or they can say this is for trading purposes for trading. So trading purposes. Okay. So if they say for speculative purposes or for trading purposes, that means the classification is true profit or loss, or the question can even tell you that it is true profit or loss. But what will you see before you know that this instrument will be classified through other comprehensive income if it is a debt instrument? The question will tell you that the company has decided to classify the instrument through other comprehensive income, or they will say certain things that will have to inform you that this classification will be true for other comprehensive income. For the other comprehensive income, what normally happens is that the entity is not having the investment for speculative purposes or trading purposes. They are willing to what? To hold it up to the date of maturity, but they will also be there waiting for any better opportunity to come so that they can sell it before the maturity. So they are indifferent. They are 50% that they are going to hold it up to maturity, but they will also be waiting for what? A better opportunity to come so that they can sell it before the maturity. So this one, they will say that the company, the business model of the company is to hold the investment up to maturity whilst waiting for any better opportunity to sell it for again. That will tell you that it is other comprehensive income. The holding it to a maturity is not something that is certain. But if there's no better opportunity, you can hold it up to maturity. But if there's a better opportunity, you can sell it before the maturity date. That's how they are going to frame the question. The company is willing to hold up to maturity whilst waiting for any better opportunity to sell it. That's how they are going to frame it. So there will be a portion of holding it and a portion of what selling it when there is a better opportunity. In that case, the instrument should be classified as other comprehensive income, which is a debt instrument. But for amortized cost, the question will tell you that the company is willing to hold the instrument up to maturity and receive all the cash flows. So this one, they are certain that they are going to hold it up to maturity. So if they are going to hold it up to maturity, the amortized cost calculation is the same as the one that we know for financial liability. Transaction cost will be capitalized. This is an asset, so you are going to add. Discount will be capitalized. That will be discount received. That will be a subtraction. Then you carry it to amortized cost. You charge your interest. But the difference over here is that for other comprehensive income, at the end of the day, we fair value the instrument. But for amortized cost, there is no fair value adjustments. We just carry it at cost. So the only difference between the amortized cost classification and other comprehensive income is for the other comprehensive income, at the end of the year, we fair value the assets. But for amortized cost, there is no fair value adjustment. So this can be deemed as what? Classifying the asset through revaluation model. But this one can be as cost model. That one can be at cost model. So this one, the classification is the same. The amortization is still the same. Initial recognition, transaction cost to be capitalized, discount to be capitalized, premium to be capitalized, and if the asset is purchased at a premium, will it be addition or subtraction?
Addition.
If it is premium, if you are buying the thing at a premium, that will be a cost to you. That will be an expense to you, isn't it?
Okay.
If you
So
are,
since it's an asset, it will be since it's debt, then it's an addition.
this will be an addition, isn't it?
Yeah.
Okay. So the transaction cost will also be an addition. Okay. Okay. So the premium will also be an addition. The transaction cost will also be an addition, but discount will be a reduction. Okay. So the instrument can be purchased at a premium, but you have to know the impact of the premium. Premium, is it a cost? Yes, it's a cost, and this is an asset. So if I'm capitalizing a cost, it means that it will be a cost plus cost. But if it's a discount that will be given to will be a discount receipt, which is an income. So income reduces our cost. So if I'm capitalizing the discount, it means that it will be treated as an income, which will be credited to the asset account. So discount will be a reduction. Discount will be a reduction. Okay, so this is for the normal one. This is just for the normal amortized cost. So let's pick some question on the on the financial assets, actually some 2 questions, then we move on. Okay, let's look at the question 1.
On October 1, 2020, Kenya Sea purchased 5,500 100 debentures at their fair value of 98.12. Interest is paid annually on 30th September. The debentures are listed on the West Africa Stock Exchange and are due to mature on 30th September 2024, at which date they will be redeemable at 2% above par value. The effective interest rate applicable to the debenture is 6% per annum. Having reviewed future cash flow projections, Kenya's directors have decided that they will hold the debentures until 30th September 2024. No allowance for credit loss is required. Discuss how Kenya should account for the debentures financial statement in September 2021.
Okay. So this one, how would the instrument be classified?
Sir,
Yes, yeah.
please, your voice is down, but I don't know whether are you.
But yours is lower than his.
So maybe
His voice.
it might be his
His voice.
phone. Okay.
I don't know whether it's coming from my neck.
Then maybe it will be your one because Nick can hear me loud and clear. Okay, but I'll try to see. Okay, so how would the classification be done? How this
No
is
amortized cost.
okay. Yeah, you have to know that this is a debt instrument, isn't it? So
Yeah.
first of all, you have to identify how the financial asset is coming. It's through which instrument? Debentures. It's a debt instrument. So since it's a debt instrument, we have 3 classifications: profit or loss. So you ask yourself, will it be classified through profit or loss, other comprehensive income, or amortized cost? I'm saying that the question will tell you the business model of the what? Of the entity. They are saying that the directors have decided that the entity that they will hold the debentures until what? 30th September. So it means that they don't have any plan of selling it. So it will be through amortized cost. It will be through amortized cost. So let's look at this question. Let's take this. The coupon value is 5%. The effective interest rate is what? 6%. So let's dig into that. The number of debentures is 5,000, and each of them is purchased at 98.12. So let's look at that. Let's take that fast. So we're looking at question 1 under financial assets. Okay. So what we have to do is that we first have to find the fair value of the instruments. So let me show you something. Okay, you can see that the nominal value of the instrument is how much? The nominal value of the instruments. How much is the nominal value?
That's 98.12.
That is a fair value.
Yeah.
Okay, the nominal value is 100 cedis. The nominal value is the 100 cedis. That is the face value. Okay, but you can clearly see that they are issuing this particular instrument at a discount. You can see that the instrument is issued at a discount. Okay.
So what of the side where they said will be redeemable at 2% above par value?
Oh, that one is after or at the date of redemption. So we don't take that one into consideration. So
Okay.
if you do your calculation very well, you see that at the end of the year, the amount that you are going to be receiving will be 2% above this one. So it will be something like the 50,000 plus 2% of the 50,000. So that has been taken into consideration before estimating the effective interest rate. So the above 2% redemption at the date of the redemption, that particular amount has been taken into consideration before estimating the effective interest rate. So if you do it very well, you are going to be getting that particular value at the end, which will be the nominal value plus the 2%. So that one, we don't take that one into consideration at the date of the issuing or the purchasing, because that has been taken into consideration in the effective interest rate. But what I want to say is that you can first decide to do the calculation like this. You have your nominal value. You have your nominal value of 50,000. Okay, that will be 5,000 multiplied by, that will be 500,000. So you can have the 500,000. Then you now subtract your discounts. So you can determine the discount over here, which is the 100 minus this. Then you multiply by this and subtract. Then you now get a fair value. But to also be at the safer side, you can also calculate your fair value straightforward by multiplying the 5,000 by 98.12. So let's pick that one. So let's just calculate the fair value. So the fair value of the instrument will be 98.12 times 5,000. What are we getting?
490,600.
Okay, 190.
490.
490. Okay,
Yeah.
490.
Hello, sir.
Yes, yeah, 490,600.
Okay, so are we multiplying the 96.12?
Is that?
We multiplying the 96.12 by the 5,000.
I don't hear you, yeah.
So why are we multiplying the 98.12 by the 5,000?
Okay, okay. You're asking where we are multiplying. Okay, on 1st October, KNC purchased 5,000, 5%, 100 debentures. So the 5,000 is the number of debentures and the value is 100 cedis per debenture. Okay, that is the meaning over there, and the interest rate is 5%. So you are purchasing the debentures of 5,000 units at a value of 100 cedis each, which attracts what? An interest rate of 5%. But you should have purchased, or you should have paid what? 100 cedis for one debenture, but you are now paying 98.12. So if one debenture is 98.12, how much will be 5,000? That will be 98.12 times 5,000. So that's how come we are multiplying the 98.12 by 5,000. One unit of a debenture is 98.12. It's not all the 5,000 that is sold at 98.12. No. The price of one is 98.12, and we are purchasing 5,000. So what will be the total amount that we will be having as an asset? That's what we are doing. Senior, I hope
Okay,
you're
thank you.
okay. I hope you're
Yeah,
okay.
I'm fine.
Okay.
Yeah, thank you.
All right. So, okay. The debentures are listed on the West Africa Stock Exchange market and are due to mature on 30th September this one, at which day they will be redeemed at 2% per. That has been taken into consideration already before estimating the. So I'm saying that you can have the 500,000 first, which is the nominal value. Then you subtract the discount to have the fair value. We are all going to be on the same side. Okay, so this is the initial recognition. You are going to debit cash of 490,600. No, you are going to debit the financial asset at 490,600, and you are going to credit cash. The cash should have been 500,000, but they are giving a discount, so you are paying only what? 490,600. So you debit the financial assets and you credit cash. That is the initial recognition. Subsequent measurement, what will happen? You are going to be any interest on this particular investment. So you have to account for the interest. So we look at the subsequent measurement. The subsequent measurement must be through amortized cost. And they're asking us to do this for only 1 year. So only in a year, we are going to have our fair value. We are going to have our fair value, which is 490,600. Okay, then you have your finance income. This is an asset. So the interest will be a finance income. So that will be 0.06 times this value. That will give you the interest. How much are we having? How much are we having?
2943.
29436.
29 or 24?
29436.
Okay. What will be the coupon? The coupon will be 0.05 times 500,000. Do you agree to the 500,000? The coupon will always be paid on the face value. And the face value is 500,000. 5,000 times 100. How much are we getting?
25,000.
Okay, that will be 25,000. Okay, so at the end, what will be the value?
$495,036.
Okay, 495.
036.
Okay, 495 036. So this is the figure that you are going to show as a financial asset in the statement of financial position. This will be shown as part of the non-current assets. In the statement of profit and loss, you show this as finance income. I want us to do it up to the end of maturity so that you see the 2% something that they are talking about. How many years is it? That will be only in 3 years.
Yeah, 3 years.
Okay, let's try and see whether we can do all the 3 years. Okay, so that you show you see the impact of the 2%. Okay, so let me come. I should have used table. Okay, so this is 20. The first one is 2020 what? What is the year there? So that will be 2021. Okay, that is
Yeah, 2021.
Okay, so let's count to 2022. Okay, 2022, we have the balance as start or balance go down. Balance as start, which will be the 495,036. So we have the finance income. The finance income will be what? 0.6 times this one. 0.06 times 495,036. What are we having?
29702.
29702. So the coupon will still be the same. Okay, which will be 25,000. So what are we having?
$499.
499. Okay,
738.
499,738. Okay, so this will be 2023. So let's have the balance at start. Will be 499,936. 738 rather. Finance income will be what? What will be the finance income? And the coupon will still be 25,000.
29984.
It will be
299.
okay, 29984. Okay. What will be the difference? And that difference will go to 2024.
504.
504
722.
722. Okay. So that will be the balance brought down for this year. 504 722. Okay, so the finance income. Okay, I'm coming. Let me show the year. Let me see the year that we are going to do. So this will be redeemed. So 2020 to 2021 is 1 year. 2021, 2 years. 2022, 2023 is okay. This will be here. It's supposed to. So 2021, 2020 to 2021 is 1 year. 2021 to 2022 is 2 years. 2022 to 2023 is 3 years. Okay. 2023 to 2024 is another year. So this will be the last year. So the finance income is what?
30283.
30283. The coupon will be 25,000. Okay. So what will be the funnel?
510005.
510005. Okay. This will be the amount that we are going to pay them. Charge 2% on the 500,000 NC. Is 10,000. You can see that we are having a 5 as a result of the approximations. The 5 difference is a result of approximations. So if you do it well, this should have been 510, which is the 2% above the nominal value or the par value, because the par value is 500,000, but you are paying the people 510. That is a premium. So it means that the 2% has been taken into consideration before estimating the effective interest rate. So we don't take that one into consideration. Nick, I hope right now the
Yeah.
understanding of this one is clear. So forget about
Yes,
that.
sir.
Okay.
Thank you.
Okay. So we have done. The one that we have done is for debt, which is amortized cost. That is fine. Let's look at another one that we can do. Maybe to be equity instrument, but that will be through. Okay, let's come here. Let's look at the question 2. I want to see if it is.
So,
Okay.
Brain,
Yeah, Zina.
if the first one was going through fair value,
Okay.
what just a summary, how would I handle it?
If it should be true, they are willing to hold it or also sell it at any time that there is a better offer. So that would be through other components of equity, isn't it?
Yes, other component of it.
Okay. So other components of equity, the calculation will still be the same as what we have done here. But what we'll do is that after getting this figure, the question will give you the fair value of the instrument at this date. So you just compare over here. So maybe if the fair value of the instrument is 497,000. So it means that you have to show your instrument at 497,000. So the difference between these two will give you the gain that will be going to other comprehensive income. But if you come to the next year, what you do is you will carry the instrument at this one, because the gain is not part of the interest. The gain will not be attracting the interest. It's just a reserve.
Oh, okay.
So the calculation will be done on this one. All right. But if you come here, the figure that you are going to get over here, you add your gain.
You compare again.
You
add your gain.
You got the gain for the first year because the gain is not part of this one. The gain is not part of this calculation. You can see the figure that we have used over here is excluding the gain.
Yes.
So you add a gain to this one, which is the gain for the first year. So maybe if the gain over here will give you now 500,000, adding the gain, this is supposed to be the actual closing balance. Okay. Then you now find a fair value again. So the question will give you the fair value at the 2022 again. Then you compare. So if you compare the fair value, you will now recognize fair value gain. But the calculation, the interest will be calculated on this amount, which is the same as this one. At the reporting date, you can see that the two gains are not part of this. So you accumulate the two gains and add it over here. Then you fair value again. Then at the end of the reporting period, you are going to redeem. So if there's a fair value, you fair value again before you pay. But since you are going to be redeeming, you can ignore the fair value. So that is how it will be done. I'm just praying that we should get a question like that. And
thank you.
We see whether we can go about it. Okay, let's look at the 2 and C.
Doma bought a 10-year bond on 1st August 2016 at a cost of 45 million. The bond carries an interest coupon of 5 million paid annually in arrears, and its effective yield to maturity was 12% at the date of purchase. Doma is holding the bond as a speculative investment, expecting its value to increase and hopes to sell the bond at a profit in the short to medium term. On July 31st, 2017, on July 31st, 2017, its reporting date, the fair value of the bond has declined to 43 million. The interest payment was received as scheduled. Required advise Doma on the treatment of the above in the financial statement for the year ended 31st July 2017 in accordance with IFRS 9 financial instrument.
Okay. All right. That's nice. Okay, this one is a debt instrument, but the classification will be through. The classification will be through what? Profit or loss.
P&L.
Okay. So the value of the instrument is 45 million. Okay. And the bond carries an interest coupon of 5 million paid annually in arrears. And its effective yield to maturity was 12% at the date of purchase. But the good thing is, do you know why they are giving you the effective yield to maturity to be 12% at the date of purchase? You can only enjoy the 12% if you are able or if you are willing to keep the investment up towards maturity. Okay, what I'm trying to tell you is that the effective interest rate does not work on profit or loss what instrument. The effective interest rate will come in because of what? The capitalization and also the discounts. But for profit or loss, we expense the transaction cost. So we use the nominal interest rate for what? Profit or loss. It will be the same. If it is 5%, which is the nominal rate, the interest rate will be 5%. Because the effective interest rate will only come in because of the impact of the transaction cost and the discount on the nominal value. So what will happen is that our coupon interest is actually the interest that these people will be receiving. So the coupon interest is actually the interest, which is 5 million. Okay. So the fair value, there's no the entry for this particular transaction. There is no transaction cost. There is no anything. So what will happen is that the instrument will initially be carried out. Will be carried at 45 million. So the instrument will be carried at the fair value of 45 million. Okay. So what will happen? This one, if you are doing effective, if you want to carry it at amortized cost, it will still be the same. What will happen is that you see that you'll be having a finance income of 5. Finance income will be 5. Finance income will be 5 million. But the coupon will be paid, which is also 5 again. So you can see that the same way you are having 45 million. So what you do is that the instrument should be carried at fair value, initially at fair value of 45 million. The coupon payment, which is the interest, will be charged to profit or loss as a finance income. But if at the end of the day, the interest wasn't paid, then the 5 million will be treated as a current liability. But all things being equal, there will not be any default in the interest payment. The interest will be paid. So the instrument should be carried at 45 million initially, but at the end, okay, the instrument should be carried at 45 million initially, and the 5% million interest should be charged to profit or loss as a finance income. By the end of the reporting period, the instrument should be what? Fair valued. It should be remeasured at its fair value. And the question is saying that the fair value at that date is what? 43 million. What is happening?
There is a loss.
There's
Okay.
a reduction.
There is a
There's
loss.
a loss
Yeah.
on valuation.
Okay, so this loss should be charged to profit or loss, and the instrument should be now be valued at 43 million in the statement of financial position of the company, which will be classified as a current asset. The instrument will be classified as a current asset.
But since the finance income is paid in arrears, won't it be a current liability at the reporting period?
Now, if it is paid in arrears, the meaning is that if you want to take the money, if you buy the thing January right now, they are going to pay at the end of the year. So this is reporting date. So it means that you have already taken the coupon. So in arrears means it will be paid. So you have purchased the thing today. It means that before you can receive the interest, it will be in a year time. So from January to December, you have already taken your interest. So your interest will be given to you at the reporting date of December, which is 31 December, before you even present the financial statements. Unless the question says that the interest was not paid at the end of the year. So then that is where you show the interest at current liability. Is it okay?
Yes.
Okay. So that is all about this one. The effective interest rate over there is only applicable when you are willing to what? To hold the instrument up to maturity. Okay. So that is all about that. Let's look at the one that we are going to have equity.
Linus, what if the bond carries an interest coupon of 5 million paid semi-annual in arrears?
Okay.
Will the distance still be 5 million or 2.5?
It depends on the year that you are reporting. If you are reporting, if you are reporting for a full year, it will still be the 5 million. But the only thing is they will pay 2.5 first for the first month.
Okay.
Then they will pay the remaining 2.5 at the end of the year.
Okay.
But if the reporting is only 6 months, then it means that you are going to charge only 2.5 as the finance income. Because the 5 million only 6 months has been exhausted for this year.
Okay. All right.
All right.
But you also mentioned in default. Can you elaborate on it?
If it to be
in case of
default, okay, in case of default, it means that the interest is going to attract interest. So
the interest will attract
okay, assuming the money is 45 million, okay,
yes,
it's 45 million. So interest is paid semi-annually in arrears. So it means that at the end of first 6 months, I have to receive 2.5 million.
exactly.
But you haven't given it to me. It means that the amount that you are owing me now is what? 4.75. So I have to charge the last year interest on the full amount. But if you should have paid the 2.5 to me, it means that you are still owing me 45 million. So the interest that I will charge you is still for 2.5. But since you are not paying this one, it means that I will roll over the interest together with the principal. So since you are keeping my money, you have to pay interest on it. So if there's a default, the interest will be charged on both the principal and then the interest itself.
And the interest, okay, all
right.
Okay.
Okay, let's pick another one. Let's try and see whether we can get the two that we have solved. They are all financial asset through debt, through debt components. Let's look at whether we can get one that will be for equity. Okay, maybe question 2 is equity. Let's look at that.
Question 3 or question 2?
Question 3.
On November 1, 2020, Somanya purchased 80,000 shares, representing 9.9% of the total issued share capital in Krobo for 500,000 plus transaction cost of 4,000. Somanya's directors see that the Krobo investment as a strategic one and have no intention of selling the shares. Consequently, they have designated this investment to be measured at fair value through other comprehensive income. On 30th June 2021, the reporting date, Krobo shares were trading at a price of 6.54 each. No entries have been made except for the purchases being included in non-current assets and the transaction cost written off as part of operating expenses. Explain the correct accounting treatment of this investment and show how it should be dealt with in the 2021 financial statement of Somani.
Okay, that is nice. How many shares are we buying? How many shares is Somania buying?
50,000.
Okay, they are buying 80,000 for the value of what? 500,000. Okay, but in addition to this one, they incur a transaction cost of 4,000. But they are saying that they have no intention of selling this particular what? Investment. But you can see that this is a financial asset through what? Equity instrument, isn't it? So the classification
Yes.
is falling to profit or loss or other comprehensive what? Income. So which of them are we using? Other comprehensive income. Okay, the question have even stated it. Okay, through other comprehensive income. If it is through other comprehensive income, the meaning is that the instrument will not be sold. So the transaction cost cannot be expensed. So we capitalize the transaction cost. So the transaction cost must be added to the initial amount. So we have to have 504,000 as the fair value at the date of the transaction. Transaction cost should be what? Should be capitalized, not expensed. Okay. This is equity, so you have to receive dividends at the end of the year. Do we have any issue about dividend payment in the question?
No.
Okay. But if there should be a dividend payment, assuming they see that the company has paid a dividend of 50,000, what will be the portion of the dividend that will be for Somania?
9.9%.
9.9%.
Okay, that will be 9.9%. So if there's a dividend paid, you calculate the Somania's portion of the dividend and send it to what? Profit or loss as a finance. The finance income there will go to profit or loss. It is the gain that will go to other components of everything.
Okay, thank you.
All right. So if you come here, there is no issue about the dividend. So there won't be any dividend, but the instrument will be carried at what? 504,000 initially. By the reporting date, this particular instrument must be fair valued. And we are giving an information on the fair value. They are saying that at the reporting date, what is happening is that the share of the company that we are purchasing is trading at 6.54 each. So the price of each share is 6.54. We want to know the value of the shares that we have in them at the reporting date. How do we calculate that value?
523,200. Multiply the 6.54 by the 80,000.
So we have 6.54 times 80,000, and that will give us 500 what?
23,200.
200. Okay. So what is happening? You can see that the value was 504,000, but at the end, the value of the shares that we have over here is 523,200. What is happening?
Again,
There's an increase of how much?
19,200.
19,200. So this 19,200 should be sent to other comprehensive income. Okay. So in the statement of financial position, you are going to show your financial asset at 523,200. This will be the value. So what you do now is that the transaction cost should be what? Should be reversed, because transaction costs have to be what? Have to be capitalized. So you go and reverse your transaction cost in the profit or loss. But you can see that they say including non-current assets is the nominal value, which is 500,000. So you have to go and increase it by 23,200. That is all. So you just explain how this should be done. This is financial asset classified, or this is a financial asset which is acquired through equity instrument. So the classification is only two. They have already stated that. So since the company is making a decision to measure the instrument or the financial asset through other comprehensive income, it means that the company has no intention of selling it. Therefore, transaction cost should be capitalized, not expensed. So the 4,000 should be reversed from the profit, or should be added back to the profit. So initially, the instrument should be carried at 504,000, which is the nominal value of 500,000 plus the 4,000. If there's any dividend paid, the dividend should be calculated and charged towards profit or loss as a finance income. By the reporting date, the value of the shares must be fair valued to 523,200, which is calculated as the 80,000 multiplied by the share price at the reporting date. So there will be a gain of 19,200, which should be taken to what other components of equity. Okay, we should be charged to after the class. WhatsApp any number on the okay. I'll just WhatsApp if you have my number, just WhatsApp me. But I'll write a number after the class. So the gain should be taken to other components of other comprehensive income, and the financial assets should be shown at the new fair value in the statement of financial position. That is all. Let's see whether we can get the next one here. This one is also bond. Let me see how they are classifying it so that if it is true, other comprehensive income, then we use this one to do what I was talking about first. Okay. All right. So let me see. Let me see. Okay, let's see this one. Okay, this is let's look at this one. This is a purchase of this sell, and this is a disposal of. Okay, let's look at the disposal there.
They held 3% holding of shares in Begro.
Let's forget about this one. I want us to use the question 4. Okay, so someone say let me share the question. Okay, so you can read the question 4. Let's take the question 4, then read.
On 1st April 2019, Sunyani acquired 80 million of 6% listed bonds at their nominal value. Sunyani may sell or hold bonds to maturity, and so based on this business model, has designated the bonds as fair value through other comprehensive income. The effective rate of interest on the bond is also 6%. The bonds had a fair value of 75 million on 31st March 2020. Please, can you go up with?
Okay.
You are correctly corrected.
And where the bond had a fair value of 75 million at 31st March 2020 and were correctly treated in the financial statement of that year. On 31st March 2021, Sunyani received the coupon interest of 6 million, which was recorded within interest received, and then sold the bond on the same day for 65 million. The disposal proceeds were substantially below the fair value of the bond, which was 69 million at 31st March 2020. A 10 million loss on disposal was charged against profit. Sunyani has an option to repurchase the bond at any time up to 31st December 2022 for 67.5 million. The fair value is expected to increase in the future, and it is highly likely that Sunyani will exercise this option. Discuss the appropriateness of how Sunyani dealt with the bonds in its financial statement for the year ended 31st March 2021.
Okay, that's nice. Okay, so let's look at this thing that they are going to be using here. This is debt instrument, financial asset through debt instrument. Okay, but let's look at what they are doing over here. What is the business model? What is the decision to this particular investment?
They are holding it through comprehensive income.
Okay.
Other comprehensive income.
So you can see that it says Sunyani may sell or hold bonds to maturity and so based on this business model. So this one, they can even decide not to give you the one that you are going to use. So you have to use this particular statement. Sunyani may sell or hold bonds to maturity. So that will be for other comprehensive income. This one, they can decide not to see what they are going to do. So the effective interest rate on the bond is also 6%. The bond had a fair value of 75 million at 31 March 2020, and we are correctly treated in the financial statement of that year. Okay, so let's now come here. Let's do our workings. First, for you to be able to comment on the accounting treatment done by them, you first have to get your figures right before you can do your issues. So the fair value of the bond, the fair value of the bond is 80 million. That is at the date of the transaction, isn't it? All right. There is no issue cost. There is no discount. So what will happen is that for this particular year, for that particular year, what will happen is that is April 2019. But they are saying that the fair value of the bond was 75 million at 31. So this, you can see that this fair value given to you is at the reporting date. Can you see that it's at the reporting date for the 2020 year? Okay.
Yeah.
So we do our interest first. We do our computation. This is this was done. The instrument was acquired on 1st April 2019. So from 1st April to March 2020, what will happen? We calculate our finance income on this particular instrument. So the finance income is 6%. So 6% of this, how much are we getting? And the coupon will also be the 6%, 0.06 times 80. So how much are we getting for?
2.4.
0.6 times 80. Okay, I'm getting 4.8.
4.8. Sorry.
Okay, 4.8. So 4.8. So you can see that at the end, the value will still be what? 80 million. Okay, but let's see what they are saying there. Okay, let's see what they are saying there. Okay, let's see what they are saying there. Okay, acquired 80% million of 6% listed bonds at their nominal value. Okay, so Nani may sold this and this. The effective interest rate is also 80%. Okay, the bond had a fair value of this on this date. Okay, okay, so the bond had a fair value of this one. So let's come to the reporting date for this. Okay, so at the reporting date, what we do is that we fair value this particular bond. So we determine a gain or loss. So let's come to this one. Would that be a loss or gain? The fair value is 75.
A loss.
So we have a loss. That will be 5. So this loss will go to other comprehensive income. Okay. So in the 2020 year, our statement of profit will show a finance income of this one, and other components of other comprehensive income will show a loss of what? 5 million. In the statement of financial position, our financial asset will be shown at their fair value at the reporting date. Okay, let's come to 2021 year. The 2021 year, our balance brought down, or balance at start, will still be the 80 million. The interest will still be charged at this amount, not the fair value, not the 75, because this 75 will not be taking interest. The loss will not be taking interest. So we are just deciding to fair value the instruments. But to those people, they will still be charging the interest on the what? On the value that they have in their books as the liability. So we still charge the finance income. We still charge the finance income at 4.8, coupon at 4.8. So we still have the 80. But what we do is that the actual closing balance should have been 75. So we subtract the loss. So the fair value, the actual fair value should have been 80 minus the loss, which would be 75. This is the fair value of the bond for 2021. Let's now come to what is the fair value that they are giving to us. Okay, on 31 March 2021, Sonyani received a coupon interest of 6 million. This might be a mistake, which was recorded within interest received. So the coupon interest should be 4.8, not 6 million. So it should be 4.8, not 6 million. Okay, so this one, someone can say that maybe they have paid part of the interest in advance. Okay, that is not an issue. That should not be an issue. Since they are saying the coupon interest of 6 million, it means that they are just talking about the entire coupon interest. But since it is 4.8 and they are paying 6 million, it means that they are paying the interest of 1.2 in advance. So that will be a liability to them, which was recorded within interest received, So if actually the figures are right, then it means that the interest should have been 4.8, but they have received what? 6 million. So
6 million.
the people have paid 1.2 million in advance, and that will be a liability to the Sonyani Limited. Okay, within interest received, and then sold the bond on the same day for 65 million, and then sold the bond on the same day for 65 million. But what is the value of the bond? What's supposed to be the value of the bond for this one?
75
So we are selling
at closing.
Okay, we are selling at 65. So that means there will be a loss of what?
10 million.
10 million. So let me check whether they have said something about the 10 million there. So a 10 million loss on disposal was charged against profit. So it means that, okay, so this should be, the 1.2 out of this should be a liability. Okay, because the figures that they have given to us were right. Okay, and so the bonds on the same day for 65 million. So the fair value should have been 75. We are selling for 65 million. That is a loss. Okay. The disposal proceeds were substantially below the fair value of the bonds, which was 69 million. So at 31 March. So for us not to be in rush, we first have to fair value the instruments before we do the selling. So by the end of the day, you are going to get the same loss. Okay, the effect will still be the same. So let's fair value it first before we move on. So let's fair value. So at the reporting date, our fair value will be 69. So our fair value will be 69. Okay, if the fair value is 69, what will be the loss that will go to other components of other comprehensive income?
6.
That will be 6. Okay. And at the same day, we are selling at what? At 65. So it means that the value of the instrument should have been 69, but we are selling at 65. So that will be proceeds. So the proceeds from disposal will be this one. So the loss on disposal will be 4, isn't it? Okay. But you can see that the 10 over here has been split between other comprehensive income and what? Profit or loss. So this will go to profit or loss. So you can see that they charge the 10 million to profit or loss, which should not be the case. The instrument to first be what? Before you sell, you have to first fair value the instrument before you sell. So if you fair value, there will be a loss of 6 million to other comprehensive income. After the disposal, there will be a loss on disposal of 4 million. So the 10 million that was charged to profit or loss should be split between other comprehensive income and profit or loss. Okay, so let's come to what they are saying again. Okay, let's come to what they are saying. Okay, the proceeds were substantially below their fair value of the proceeds, which was 69 million at this one. A 10 million loss on disposal was charged against profit. No, the instrument should first be fair value. So they have done everything right to this particular stage, but the instruments should first be fair value on 31st March 2021 before the sale. So if we fair value, there will be a loss of 6 million And if you sell, there will be a loss of 4 million.
4
So
million.
only 4 million that will go to profit or loss. 6 million will go to what? Other comprehensive what? Income. Okay. Sonyani has an option to repurchase the bond at any time up to 31 December for 67.5 million. The fair value is expected to increase in the future. It is likely that Sonyani will exercise this option. What they are trying to say is that before you even account for the sale, you have to ask yourself whether this particular transaction is qualified as a sale. What do we mean by is qualified as a sale? We can only say this is a sale when the rights control associated with the instrument or with the asset has been passed to the third party. So you have to ask yourself, has the financial asset or the instrument has it been given to the third party or the buyer? Has the buyer has the right, or the buyer has he or has she or she has the right to the contractual cash flows that will be coming from the instrument? If yes, it means that we have transferred the instrument to the buyer, so that is a sale. But there can be a situation where the instrument, we say that we have sold the instrument to the buyer, but we are still incurring any loss, any fluctuation, any increase in the fluctuation rate of this one. We are still taking care of those ones. It means that the risks associated with the what? With the instrument has not been passed to what? To the buyer. Okay, yeah. So the risks associated with the instrument has not been passed to the buyer. In that case, this particular instrument will be seen as a collateral security for taking loan from the buyer. So it is not that it's not a sale. So you still classify the amount that you have received as a loan and still continue to recognize the financial assets. So for you to know this is a sale so that you can remove the asset from your books, you have to subject this particular transaction to the principles of IFRS what? 15, revenue from contract with customers. When do we say that there is a sale? We say that there is a sale when the rights, the control, the risks, the maintenance associated with the asset has been passed on to what? To the buyer. So if this particular asset, we're saying that we are selling it, but still, if there is any loss, we have to compensate the buyer. If there is any loss, we are going to suffer. It means that the risks associated with the asset has not been passed to the buyer. So we still keep the asset and treat the amount that we have received from the buyer as a loan. But in this case, we can't be able to establish this. So we assume that this is a sale. So we de-recognize the financial asset from our books and now recognize any profit or loss on the sale. Okay, what we have to do is that what is the cumulative loss on the asset, the fair value loss? What is the cumulative one? The first one was 5 million. The second one was
11.
so that will be 11 million. So after the disposal of the instrument, if it's a debt instrument, after the disposal, all the gain or losses that were recognized in other comprehensive income must be recycled to retain earnings or profit or loss. What we mean is that they must be moved from the other comprehensive income to what? Profit or loss. So the 11 million will be sent to what? Retain earnings. So we have to recycle them to profit or loss. We have to recycle them to profit or loss. We have to remove them because the instruments are no longer there. So for a debt instrument, after disposal, any gain, any previous gain that was recognized on that one must all be moved from the revaluation surplus, the revaluation gain, or other reserve to what? Retain earnings. But for equity component, we don't recycle the gains. Even if you sell the instrument, the gain will still be in the reserve. We don't transfer it to retain earnings. For debt component or debt instrument, the results will be transferred after the disposal. The results will be transferred after the disposal. So you have to talk about that particular one too. So this is a sale. So you have to de-organize the transaction. So if there is a sale, you have to subject to the principles of the IFRS 15, whether this can be a sale or not, whether the risks control, possession, the rights has been passed to the what? To the legitimate what? Buyer. All right, seniors, that is all about this particular question. So let's see whether, all right, so it's 6:39 and we have to